Market showing a slight rebound after hours. Bitcoin down another percent. That summarizes pretty damn well what's going on right now. The market itself is not anywhere near what I would consider turmoil. That's kind of dramatic, but it definitely is uneasy. Zero ifs, ands, or buts about that. And we'll talk a little bit about what's going on underneath the surface, how to think about it. And for somebody like me, I'm always looking for the trades, right? Where are the ideas that come from this? Because anytime that you get movement like this, there's opportunity, which we'll talk about. So first things first. Hey, yo, what's up, Steve? Good to see you. First things first, the relative performance between S&P and Qs is profound. Qs on the day down almost 2 points, S&P down like half a point. So overall, the difference here is palpable, and it gives us a lot of insight in terms of what's driving the downside. Then if we just take a look at XLK compared to pretty much every other sector, that confirms our theory, which is tech. Tech is not doing well at all. And we'll talk about that. So first thing, volatility here still remains somewhat muted. And we're at like 18.6 VIX, which is pretty light, to be honest. But given the broader moves that we're seeing in tech, I still am of the perspective that a lot of that is artificial suppression. I actually think the VIX should be a little bit higher than that. I'm actually starting like a big swath of research on trying to calibrate where VIX quote unquote should be, which is really, really difficult to actually isolate shit. It's a nightmare, but it's a fun project nonetheless. We'll see. Whenever I get something out of there, it's probably going to take a while. But that is one underlying thing I'm keeping an eye on. Bonds are still trickling down. And then actually, if you take a quick look at the dollar, you'll see that the dollar had fallen precipitously to like the 95 handle-ish, just above the 95.5 handle, but into the 95s. And it started rallying out really, really strong. So when I piece together everything that's going on here, the market in a nutshell is showing us that there are some severe pockets of weakness. And a lot of this actually seems to be also driven from earnings. Great example of that is AMD. Let's take a quick look at AMD because this is a fantastic story. AMD had been running, gap up here, running sideways for a little bit. Last earnings came in $1.20 versus an estimate of like 98 cents. And then we flow along, trickling sideways, still general uptrend. And then we have earnings today. Earnings came in at $1.53 versus a $1.10 or $1.11 estimate. And forward guidance did not look bad, but it absolutely cratered. It's down 17%. What the fuck happened here? Really simple idea. We'll never know in full end to end what drove the move, but they did have weaker Q1 guidance. And that's based on a year-over-year perspective. So when the market saw that, didn't like it. What does this tell us? Again, as we go through these kinds of conversations, I implore you, do not be a passive listener, just listening to the fucking things that are coming out of my mouth. Most of the stuff that I'm saying so far is shit that you can all look up. I just try to condense it down to make it more convenient for you. But your brain should continually be thinking, like, what's the nuance here? What's the so what here? What kind of ideas can I generate? And one of the things that stands out to me by far is the expectation of the market. What this is telling you is that tech has been priced so rich for so long that it is absolutely facing a bit of overhead constraint, and it needs to deliver near perfectly in order to then be priced moderately fair. Take a look at Palantir. Palantir is another prime example of this. Palantir objectively had a pretty good earnings overall. They came in at 25 cents versus 17-cent estimate, and the initial reaction was fair, right? They reported after the gap up, pretty big gap up, collapsed down, and then it had a outsized continuation on the day here, down 11.6%. These really, really high valuation names are essentially in a no-fail scenario. They need to deliver effectively perfectly. And if there's any deviation, any weakness off of perfection, you get this treatment here, which is also what AMD is getting. What's the tradable idea there? Bunch of different things you can do. First thing, you can start doing some of what I do, which is just a modified sector rotation, looking for pockets of strength. There is extreme strength in stuff like XLE. There are extreme upside potentials in things like staples, in materials, in industrials. We're seeing things crack highs. Then we're also seeing stuff like healthcare, which has continued to be in the top general bucket of winning over different momentum look back periods. So the point there is there's still really good strength. The movement that you're seeing now is not full market yet. What you're seeing right now in terms of this pullback and in terms of the down move is definitely stemming from a handful of market cap weighted names. And if we take a peek, I did this on the Irvin stream earlier, but it is worth doing again for those that didn't see that, is this. If I go out a year, tech is effectively in third place, up 21%. If I go back 3 years out of curiosity, tech is second. And then if I go out 5 years, tech is second again at like 125. But as soon as I go to 6 months, notice how tech plummets to third from last. And it's barely positive over the last 6 months. 3 months, loser, bottom, pretty much almost doubling in a half. The next closest in utilities, which is negative. Only 3 are negative. And IT is one of them. One thing to note here, comm services, still very positive. So if you still want some sort of tech exposure to the upside, you have it. You have it in comm services, which is absolutely bucking the broader trend. Then if we come into 1 month, you can see comm services is still kind of towards the middle. And then IT, bottom feeder, absolute dead last by over twice the next lowest. And then 5 day, same story yet again. If we look inside IT, this is where things get interesting. Take a look at the 5 day change. There are still segments of strength. But then if we take a look at where the losers are, and if we look at the size of a lot of these losers, they're big companies. AMD is literally third here. We have Intuit. We have Oracle, we have Now, Microsoft, ANET, Micron. All of these different names are really big names, and they're down over the last 5 days, double digits. CrowdStrike, Amat, Palantir. What I'm highlighting is the weakness that you see is not total. And the weakness that you see is actually very interesting because some of these are continuations to the downside, like IT. Some of them are near-term reversals like this, like KLAC. If we take a look at CLAC, post earnings, it's getting absolutely crushed. The question a trader should ask themselves here is, do I feel this move is warranted? The only way you could really do that is by analyzing the earnings of what happened. And then you could play this one of two ways. You could either say, well, I expect continued downside and post earnings announcement drift to the downside based on whatever your criteria is for that effect. It's a big one that I trade. Or you could say, I think that this is a near-term reaction that's being exacerbated by the rest of the sector. And I think that the longer-term momentum is more likely to carry out than not. Up to you to decide. But literally two sides of the very same coin. That's something that's been highlighted in a different way than the others. Because if we take a look at something again like IT is a fantastic example of something that is shown weakness, persistent weakness, and continual weakness. This is actually something that is a pretty simple fade, other than the fact that it's freaking illiquid as shit. Really hard to trade this thing. So whenever I'm trading something like this, it is in some of the other portfolios that I manage. That's been one of the funnest things, I'm not going to lie, about managing some of my family members' portfolios is I get to trade things that don't necessarily make sense in my portfolio, but I still like the ideas. It's a high-class problem to have, but it is a real problem. What you will find is as your portfolio grows, in order to put on stuff that's like a reasonable size, you absolutely get priced out of things. And I'll show you. Let's go into like the 20 March here. And let's say that let me grab my little drawing pad. Actually, we could use the Excel sheet. It's probably a little easier. Let's say that you're trading, I'll get rid of this stuff, $5 million. And let's say that you want to risk 0.5% on an individual trade. So that means that you need to have about 25 grand of risk. If we want to sell some calls here, let's say that you want to sell these 30 Delta calls. And let's say that based on your management approach, let's say that you would consider yourself wrong if it breaks above 170. Right? The idea here, again, I'm just piecing together something to show you like a liquidity constraint. So let's say that if it gets above 170, that's where we would consider the idea wrong and we would get out. So let's flag 170. And now we have to size this. So if we start building out this trade and we essentially said we need about 25 grand of risk for this thing to generally fit the rest of the portfolio. That means that we need to be at about a 50 lot. Well, if we go to what's offered here and you look at the bid is only 37 at 410. So what that means is, one, you are not going to be able to get filled in between this market at that size at all. The second thing is you're literally going to sweep up the entire bid. And then now you have a partial fill because you have 37 out of your 50. And then you need to find whatever the next price that comes in, and it's going to detect that activity and it's going to bid you down. So that's the rub. But the cool part is if you're trading smaller portfolios, you're very realistic. If you're doing a 5 lot, a 10 lot to get a fill, something a little bit more towards the mid. So definitely a high-class problem to have, but it is absolutely a problem in something that sneaks up on you in a good way, but definitely exists. Steve says, I mean, disconnected from real life, if investors expect literal perfection, nothing is perfect. Yeah, I wouldn't take it quite that literally. When I'm talking about like Palantir and these other names, essentially what they're saying is, and it's not about like what's fair, right? The way to think about companies like Palantir is that when they're priced literally in the hundreds of forward PEs, let's take a quick look out of curiosity. Funny enough, I literally have it up. Its forward PE right now is 158. If you have a forward PE of 158, your requirement to grow is astronomical. You have to deliver and you have to maintain good performance in order for this to even be marginally accepted. Because again, most people know in tech PEs can be high, but I mean, Jesus fucking Christ, like 160 is insane, especially compared to the trailing 12-month PE, which is over 200. So I wouldn't take it quite that literally, but not that far off. And it's not that like the world isn't perfect and stuff like that, but it does mean right now where it's being priced and what people are willing to pay changes based on how it performs. So right now, people essentially are saying, you didn't perform the way I think you should have. And because of that, you're not worth $190 to me right now. That's way too expensive for what this thing is. Then as it starts to find its way back, gain a footing, then definitely can start to trickle back up from there. But let's take a quick look at Palantir's earnings. I'm going to have ChatGPT run an analysis while we do this. Analyze in detail. I'll do AMD and PLTR's most recent earnings, include key trends and forward guidance. And I'll let that run in the background. All right, back here. And back to this sector rotation thing. So this is looking inside IT. There's places you can play inside IT. Now, a lot of times when I'm trying to trade downside movements, my preference is actually not to be in large caps. I don't want to necessarily be in large caps here. The reason why I don't want to be in large caps is because they're just slower. I find personally, when I'm trading things to the downside, I really do much better with quicker velocity. I do not perform as well with longer term thematic downside plays. Just don't do that well. My data in terms of like my trade logs and trade history backs that up. It's something that I've literally just accepted. And the reason for that, by the way, is trading is one of those interesting places where it really does make a lot of sense, I believe, to lean into your strengths. And you have to make sure that you don't have any like egregious glaring weaknesses, but you don't really get bonus credit for rounding out your weaknesses and investing a ton of time into that. A great example of that is like a basketball player like Dennis Rodman. Dennis Rodman was literally pivotal to what Michael Jordan was able to do. Same with somebody like Scottie Pippen. But Dennis Rodman had a very, very, very particular strength, and he leaned into that heavily. And he did not spend a ton of time trying to worry about the other weaknesses in his game relative. Similar concept in trading. I think there's something to be said about specialization, especially if you are a limited time constraint trader. You're probably better off specializing more deeply. Somebody like me, I'm fortunate enough that I've been doing this for so fucking long that my specializations definitely have spread out, but I still am quite specialized, right? That's why I mostly talk about derivatives and stuff like that. So going back to one of the things, know thyself, I definitely know I prefer stronger downside moves and shorter hold periods for them. For that, if I'm trading something that's based on an S&P trend, sector trend, I can generally expect that that trend will hold true across other indices and specifically market caps. So let's do a quick scan and I'll show you what I mean. We can look for something that has had pretty strong or pretty rough near-term price movement. And I think we could do this. So these are things that have looked and have posted new 52-week lows. These are things that are literally at the very bottom, at least at some point, of their ranges. And in here, I can find a lot of stuff that's smaller and likely has exhibited much more downside momentum. I don't know what the fuck is going on in here. Anytime you get into biotech, you are now in the Wild West. And it's because this insane gap up is probably from some sort of drug approval or some sort of FDA thing that positively benefited the stock. And then there's a subsequent unwind off of it, which again that's just how those things go. A lot of times when I'm doing stuff like this, I literally will get rid of the medical industry. And it's just because of that kind of factor. It can be just absolutely obscene. So we'll take a look at maybe a couple more. And this is a great example. So U is getting demolished, absolutely demolished. And this would be something that I very reasonably would add to a short list in order to follow up and see if I want to get some short deltas in here, especially because the move really started ramping up even before its earnings. It does have earnings coming up. So let's take a quick look at what the lean looks like coming into earnings. Oh, super bullish out here, but in the front, less so. That's an interesting position. What is that in? 18 June? Go take a look at when that came in. And let's find where that is. Looks like here the 50s. Most of that is on the sell side. So it must be some in the money stuff. Yeah, because by strike, looks like the 42s. See if we can find them. What did I say? 18 June? Here. Oh, it's on the put side. So there must be some sort of short puts. What is it at? The 42s. Yeah, so it is at the 42s. Back here, the 42 puts. Yeah, okay. There it is. That's recent. Very recent. That's a very interesting trade with earnings coming up. Was that yesterday? Volume today was just under. Yeah, it looks like some part of a synthetic to me. At least that's what I see. So anyways, that's another approach here. Now, another idea to play along the broader weakness that you're seeing in tech is actually to find things that are exhibiting really good strength. So energy, really good place to look right now. And if we take a look across energy and see what's kind of dominating, you can still see, funny enough, how it's not at the peak anymore compared to the others. But I've been trading HAL to the upside for a little while now. We identified this a while ago as something that was leading the energy sector in general. But it is not necessarily outperforming excessively in the near term. So let me see. Real says it is a big rotation that's happening from tech to the other sectors, from growth to value. There's still a problem in liquidity too. I'm actually not sure if I agree with that, to be honest. And there's a few reasons for that. Like we're not actually seeing some sort of massive ETF flows into value. I think that we're just seeing some level of outflows from individual names, and it's not even that many within tech. But I do agree, at least in terms of there's absolutely artifacts of flow into staples. That I think is a very fair statement. But I don't actually think that the broader outflows are broad in tech. I think that they're more narrow. I also wonder because, like, if we take a look at things like IWM is doing relatively better, but still not great here compared to the others. Definitely more resilient. I think year to date, where is IWM? I'll tell you right now. IWM is crushing everything year to date. IWM year to date is up 5.2%, whereas Q's is down 2.3%, and S&P is up 0.07%. So just kind of about flat. But yeah, I would agree with the broader sentiment that there's definitely rotation going on, but I'm just not convinced that it's like this mass rotation out of tech yet. Love says, can you cover GME? Yeah, let's take a quick peek at GME. GME, we looked at this a little bit yesterday, but happy to take a peek again. There was some interesting options activity that I came across in here. And I'm also really, really stoked to see it hanging around about these levels, which I didn't fully expect. I still have the covered strangle going on in here, but the options chain, I'll show you. The options chain from 2 Feb had some pretty strong call premiums go out. But the interesting thing is, I think whatever this was fucking wrong. And I saw it completely invert effectively the very next day. So I think that there's still a pretty net bullish upside, but it's not as strong as it was before. Definitely not as generally noteworthy to me, at least. And if you take a look at the OI for the front, we can see definitely build out on the calls. And as usual, I mean, pretty standard fare. Most of them are a bit out of the money. And then there's always that activity that you guys see at the tails. So in my opinion, right now, vol in GameStop is still high generally compared to other names, but it's very low compared to itself. And the total OI definitely has heavy call skew, but a lot of this OI at this point are people selling calls. And I think a lot of these people are probably selling calls against long shares. Again, it's something that I'm doing. And it's because the vol in here is so good that it's hard to turn that down. We are starting to see a little bit of skew coming back, but it's not that big yet. So if we take a look at like the right out of the monies, the 47 delta, those are 61% vol. And then if we take a look at like the 40 deltas on the put side, that's at like 57.5. So the skew isn't that profound compared to what it typically would be, which is one of the things that I kind of keep an eyeball on GameStop to figure out if I'm going to start getting excited or not. So yeah, a little bit quiet right now, I think. The good part is I'm also really, really stoked on Burry starting to do more discussions and coverage on it, because he actually talked about some things that he saw as a potential target for acquisition. And that I also think is a fun conversation, but I have absolutely no context, quite literally whatsoever, when that acquisition may or may not happen. It's just, they've been sitting on the cash for so long. The one thing that is abysmal for GameStop right now is their balance sheet is getting fucked because of this Bitcoin position. So that sucks. I'm not stoked on that at all, but I'm also glad that they didn't necessarily like jump all in on cryptocurrency. But this is exactly why when people talk about and get really excited about Bitcoin and cryptocurrency in general, I get it, but it is so freaking important to understand like what this fucking thing is and how it behaves. If we look at the 5-year high-low range here, it has gone up 762%. And then from that local high right now, it's down 44%. So the moves are still absolutely profound, which is also why when people talk about Bitcoin, you know, being some sort of risk off asset or hedge, it's anything but. It really, and I like cryptocurrency. This isn't me shitting on cryptocurrency. It's literally just me accepting what the underlying instrument is, how it behaves, and what it does, because it does shit like this. And this is not stable by any stretch of the imagination. So yeah. Real says Bitcoin is the biggest scam out there. I definitely don't agree with that. I think Bitcoin is a new instrument that is still trying to figure out its place and how it's valued, but it's absolutely not a scam. I think the bigger story behind Bitcoin, as usual, is the technology that drives it, which is extremely impressive. I also think that Bitcoin has some very, very real use cases, but it also has some very, very natural enemies, because federal banks and national banks, they're not going to like cryptocurrency as much because it actually starts to pull control away from them, to control and manipulate. And I'm not using those words in a bad way necessarily, but that's what they do in terms of fiscal policy. With the interjection of something like Bitcoin, I'm just not sure that if there's exceedingly wide adoption, what kind of impact that's going to have on those kind of capabilities. I definitely don't think it's a scam. I definitely think it's super highly volatile, as new assets, completely novel new assets like this tend to be. But there's super liquid markets and a lot of people are really interested in them. So yeah. I also think this down move is really interesting to me. I don't know what to make of it, genuinely. It's like the same thing with like the massive up move in the precious metals. That's another interesting move that's, I think, difficult to make heads or tails of, with the way that just the amount of buying pressure that's been placed on those. So I do think the volatility in Bitcoin clearly is here to stay. And if we actually take a look at how the volatility in Bitcoin is progressing, it's pretty interesting. Where am I? Take a look at this. So what this is showing you is the way that overall volatility is going to behave. And the movement pattern of it is very up and down, back and forth. You're seeing a lot of oscillations in vol. And again, maybe an easier way to look at it is through the term structure. And if we go back to like June, you could see, right, like how much lower nominally all of this was. So yeah, the volatility in here doesn't seem to be going anywhere whatsoever. Peter says other cryptos like ETH and Monero have much better utility. Bitcoin is the OG though. Yeah, and I think there's a lot of interesting use cases depending on, right, like if you're looking for security, if you're looking for anonymity. But yeah, there is a lot of benefit to being the incumbent. And what most people come across first, it's kind of like how some people, they still call things like tissues, they'll call them Kleenex, right? Which is a fucking brand. And there's a lot of small little examples like that. But yeah, I think there's a lot of advantage there for sure. Real says, let's bring Ewan Sinclair. I actually reached out to him. He's traveling right now, but he'll definitely be on again. If you haven't seen, I must have done at least 5 to 10 podcasts with him. So there's a ton of really, really good conversations you can find on the channel with him. If you just type in his name, you'll come across a bunch. But yeah, definitely we'll have him on again. I'm actually working on a project right now with Augustin that's generally been deprioritized, but I am going to try to do that at some point. I think that'll be a really good podcast episode. I wanted to read this. This came from Coinbase, and it's about Bitcoin. And I figured who else has a stronger vested interest in discussing what's going on in Bitcoin than something like Coinbase. So let's read this. This is just saying that it's down. Sharp escalation in U.S.-Iran tensions, a surging dollar after Kevin Warsh's Fed, and cascading forced liquidations have driven broad sell-offs across crypto, gold, silver. See, like, I really just don't fucking know about this, man. Like, I really just don't know about this. Escalations in US-Iran tensions, I think, is complete bullshit. Like, I do not buy that whatsoever. The surging dollar. Well, let's just eyeball this. Let's eyeball this theory of surging dollar against the cryptocurrency. So we'll go to the dollar here, and let's go to cryptocurrency here. This doesn't that doesn't jive. This precipitous collapse in Bitcoin it didn't coincide with any sort of surge. The high-low move here was less than a fucking percent, and it's been broadly declining. So again, like, this is literal utter bullshit. And the only thing that I think has any weight in here, which I've heard before that I'm just also not super convinced of, is the forced liquidations. I just don't know. Yeah, I just don't know about this forced liquidations thing. But there's also, that one's really difficult to prove or disprove until we get filings. So I can't logically comment on that one way or the other. But what I can comment on is the first two things listed here are literal bullshit. And we can, it takes 2 seconds to take a look at those. You can look at all the other iterations where US-Iran annotations in like news via like Google popped up and expanded to proxy what Iran tensions escalating means. And you can see how Bitcoin behaved against that. Cliff notes, no real correlation there. So yeah, I don't know what the fuck CoinDesk is talking about, but this is literally fucking stupid to me. Altogether, cryptocurrencies lost 1.7 trillion. Prices began to rebound after the House of Rep passed the funding package to head off another government shutdown. So for those that don't know, there was the partial shutdown, but that generally seems to be averted. And let's see. Before the recent downturn, major factors driving repeated all-time highs, explosive growth of crypto ETFs. That makes sense. Such ETFs buy crypto, sell shares. Yep. That's fine. Buyers who entered the market via US spot exchange traded funds paid an average of 84.1 per coin, and it's now at 78. And they're sitting on paper losses like 8 to 9%. Okay. I don't think that matters though. Still. So what? Oh my God, strategy. Jesus Christ. I don't fucking, let's see what they say. Just before the weekend dip, Bitcoin accumulating behemoth strategy bought 855 Bitcoin. Yeah, I mean, that's a fucking whole other, that's a whole other thing. Down 67% over the last 6 months. Why strategy down 60, the leverage stuff. Yeah, fuck all that. Okay, let's see what this says. Crypto celebrating all-time highs. Yes. Okay, here we go. No single factor. Agreed. I like that. Market watchers agree about some of the factors. Okay. Stocks and precious metals have seen increased volatility as traders weighed this. Fine. This is all bullshit. The only thing that I actually like here is this: no one single factor. This effectively summarizes is to the market has shit going on, right? Like, when the fuck is geopolitical tensions massively increased most recently, where the US last year plus was sitting there talking shit, throwing tariffs out at everybody. Fucking, if you looked at us wrong, apparently you got a tariff. Then we're talking about like annexing Canada and striking. We just ripped a president out of fucking Venezuela. We're talking about snatching up Greenland. Like, my boy, rising geopolitical tensions, they've fucking been risen, dog. Like, they're not rising. They're risen. He is risen. Political tensions being he. The partial shutdown, whatever. The Federal Reserve Chair, I do think that caused near-term movement for sure, but I still don't think that was that crazy. So yeah. Anyways, let's continue. Because it trades 24/7, it can react to news that breaks while traditional markets are closed. Functionally correct. Weekend trading, meanwhile, is also defined by thinner liquidity. Yes. Meaning that there are fewer buyers and sellers. Yes. The result, prices can often see volatility. Yes, but this isn't the fucking move. Oh my God. This is terrible. I am genuinely surprised at how bad this is. I really opened this expecting to like receive new information that is good. Genuinely. I did not think that this was going to be this shitty. This is like the fucking layman's here's bullshit. Like, that's what this is. I'm just going to say words and it'll seem smart to lay people, but this is fucking stupid. Liquidity in crypto markets thinner since 10 October. Investor concerns elevated. Okay. The case for the continued drop. Let's see. Fear and greed, extreme fear. Investors worried about crypto's price decline continuing. Warranted. Some analysts suggest Bitcoin could be mired prolonged bearish phase. It's been my view since October. Bitcoin is sideways downside phase. I don't think 80K is a macro low. Okay. This is talking about prediction markets, it looks like. And after more than a year of bullish options trades, equivalent amount of money placed on Bitcoin falling below. If this is what I think they're doing, which is just analyzing strikes and essentially saying if people are binary betting up or down, like, that's fucking stupid. This is not a bull market. It's a full bore 2022 crypto winter. Okay. Some other person fairly optimistic, could be close to the bottom. While near-term risk skewed to the downside, approaching the final innings to the downside. None of this is giving us fucking anything. These are just like random people from random places. David Dwong. Outlook was constructive. Okay. What the? Oh, there you go. This is, aha. That's a good thing to throw at the end if you're Coinbase and hoping people don't immediately cash out all of their fucking cryptocurrencies and rip the money out from under you. You teach them about DCA. Buy a little more. Now, fun fact, one of the ways that I think about stuff like longer term holdings, DCA is great. It's completely fine. However, one of the things that I tend to like to see is some kind of strength before engaging in buying something that's precipitously declining. And if we zoom out, these are like the next spots, at least as far as I can see, where price might interact. I have absolutely no idea to what degree, as usual, and all that other kind of shit. But this, I mean, it looks like we're just now in no man's land. And I mean, I still have to favor downside expectation in the near term because that's what we've seen. We will see. But, you know, as they say, good time to learn to DCA. If you are a long-term investor, this really is a good buying opportunity. But if you're a long-term investor in stuff like Bitcoin and you're trying to trade it longer term, you do have to be really, really thoughtful about your bankroll. because you don't want to start scooping up a bunch of Bitcoin here or Bitcoin proxies, ETFs, or whatever, and it continue a pretty strong decline, and then you run out of money and then you can't DCA anymore. That's actually a critical part of the covered strangle, which is scaling protocols. It's a very, very delicate dance, because if you leave too much money aside, you do not participate as much as you should to the upside. If you leave too little money aside, then as things start to decline, you have nothing to help yourself. So one of the things that I like to use as a proxy here, and it's kind of looking at stock in terms of units and how much money you can implement at different points to accrue different units of stock. So for example, to make this point clear, let's say you have $10,000, and let's just take a look at two different points. Let's say that you bought when it was at 64, and then let's say that you could buy now when it's at 41.5 here. If we look at the total number of shares that you can get at these two different points, this introduces that idea of units. What I'm showing you is here, you can get 156 shares. Here, you can get 240 shares. It's the same total underlying, same total amount of money that you're spending, but because obviously price is cheaper, you can get more. So the reason why this matters so much is because you can actually plan out. Let's say instead of $10,000, let's say you had $100,000 you wanted to invest into Bitcoin. Well, you could figure out specifically at what levels you would want to buy how much based on the probability of hitting those levels and your expectation of it against what you think the opportunity to the upside looks like. So it's a really, really simple exercise to do that's certainly worth the time, because it turns this idea of like dollar cost averaging from this very random exercise into something that's actually very tactical and very, very methodical and purposeful, which is exactly what you need. Any questions from you guys? That's about what I got for you all today. But if you have anything that you're curious about, feel free to let me know. I'm going to throw this in the chat in the Discord as well, because this was a good read talking about like S&P quality versus other S&P factors. I kind of like that one. Real says, Eric, don't you think trading stock options is much riskier than staying with ES SPX options? No, I don't view it that way at all. Risk is always relative, right? Like if I trade E-minis or if I trade SPX, the risk that I face there depends entirely on what I'm trading and how I trade it. So for example, if in individual equities, I find myself trading vertical spreads, right? And let's say when I'm trading futures, I'm just trading at scaled size or whatever, right? Like there's that approach difference that's the dominant factor in terms of the risk that's taken. Because the other piece here is there's a difference between the types of risk, which I actually have a video that goes through all different kinds of risk, systematic risk versus not systematic risk or idiosyncratic. And there's absolutely something to be said about idiosyncratic risk, but idiosyncratic risk also impacts the indices, right? It's a good example right now, like literally right now. What's going on at this moment is if we look at S&P is down right now, right? Pretty modestly, but still down. If we measure this comes in at what? 1.6% from these highs. But if we look at something like RSP, which is an equal weighted, well, that just cracked new highs. So what is that? That's idiosyncratic risk. You have a handful of names in S&P that are murdering it. So it doesn't look exactly the same, but it's still there. So, like overall, I would say risk, I don't view like one asset class inherently risky compared to others. It has everything to do with what the trader is attempting to do. That's the easiest way to think of it. From a not as broad level view and looking at practical application, if you're trading something, for example, like earnings, and earnings plays is your thing, and you're trading short vol through earnings, that's actually a really nice non-correlated return source that's kind of like packaged risk. It can have outsized moves if you're trading naked options, but if you're sized appropriately, you're doing okay. But you have no gap risk. You have no Trump decides to try to annex Greenland, and you have no risk of that impacting what you're doing. So you can even trade individual equities with lower risk than some sort of broad market risk. And again, it all depends on the way that you choose to attempt to trade them. So yeah, it's an interesting question. It's something that I think a lot about. I think the bigger thing is just derivatives. I do believe in general, derivatives themselves just add a shit ton of complexity. So the big risk that people face when they enter the world of derivatives versus other assets is there's so much stuff that you have to learn in order to even survive before you can even do anything remotely constructive. I think that's a big risk because it's imperceptible. We did a thing for one of the every Friday we do like an options trading for beginners lab. And we did something where we were looking at like different articles that taught people. I literally typed in Google, like how to trade options. And we just looked at a handful of articles. And again, we didn't look at articles from like scrub places. We looked at articles from places you would expect, like Investopedia and some of these other more reputable places. And like the information that people get there is so goddamn awful, it's not funny. And if I look at the lens of a new trader, you don't know what you don't know. And you're going to a place that you otherwise think is reputable. And they're teaching you to trade options by picking if you want to buy a call or a put, and then picking what expiration you think based on when you think the move is going to happen. It's like terrible. It's really, really bad. So in my opinion, if you step into the world of derivatives, the asset class really is less your risk factor. Your risk factor, I think in general, is within derivatives itself. And as soon as you make that leap, you have to kind of buckle up because there's a whole lot that you got to do. But it's like the same thing when people talk about overnight risk, right? Like the people say like, oh shit, I don't want to hold trades because something terrible could happen overnight. And like this overnight boogeyman is insane. It's literally insane. We can literally look at it right now. If I download, give me a sec. I'm literally going to download S&P data and we'll look at it together. We're going to go to bar chart and let's grab SPY. I wonder if AI is decent enough to do this now. This is the last 26 years. That's good. We'll take that. And load. And then first I'm going to throw this into AI to see if it's even remotely close. And then from there, I will back check it really quick. But I feel like AI should be able to do it. I have faith. Analyze the overnight moves by using the, what is the fucking actual breakdown of this? The open to the latest. By measuring latest plot the results. All right, so let's ChatGPT. Let's see what ChatGPT can do. It is going to have to clean this. I think I've showed you guys this before. It gets this little meta tag down here. I'm actually kind of curious how well it's gonna handle that, but we'll see. And while that's going, you could easily do this analysis yourself as well. Literally just do it in Excel. We go clean this off. And we look at overnight move. And where are we at? Yeah, okay. So we're just going to use the latest. Hold on. Oh, this is cool. Yeah, do this. So plot the histogram and KDE, compare overnight to day, and the rolling stats. Anyways, you get the gist here. You would literally just do the math here, right? And see where we open compared to the close before. And this will give you your move for overnight, which a lot of people see as like some sort of terrible boogeyman. And funny enough, it isn't much of one. So anyways, yeah, you could go have fun. Take a look at that. And this is from ChatGPT, which actually looks kind of cool. Hold on, no, don't do that. Put it here. Oh my God. What the fuck? Broken. Dude. Whatever. Close this one. I'll show you guys the here. That. So here, you can see like the overwhelming majority of overnight moves don't really matter. And this is kind of interesting. Like a time series of overnight to intraday. The main thing here is overnight isn't some sort of boogeyman, but a lot of people make it out to be a boogeyman. So this is just a little bit of an offshoot from what we were talking about before. All right, gang, that wraps me up. Time for dinner. Be an outlier. See you guys later.